Hey traders, welcome to Charts and Coffee. Hope everyone's doing well. Happy Tuesday retail sales morning. Pretty interesting reaction to retail sales. A lot of chop in terms of what we're seeing on the S&P. We've had a pre-market downtrend. You can tell that on the 5-minute time frame using the multi-trend. We've been red since just before 6 to about 5 minutes before that retail sales number. We've gone neutral, and that's going to actually be a pretty nice potential morning, not only for day trading, but potentially for the swings as well, because we're neutral on the 5, which gives us actually a better environment for morning day trades. We're neutral on the 1 hour. We're neutral on the daily for the S&P, and that could set up some swings as we take a look at a shorter term time horizon, but still some overnight exposure in the S&P. Similar, but not exactly the same on the NAS. One of the things that we've been mentioning in the top tier outlook the last few weeks is to avoid NASDAQ. I know it's a popular index, it's where Apple is weighted. And that's one of the reasons I've been telling folks, hey, leave that index alone. We don't have to have this disproportionate preoccupation with tech, which oftentimes can happen. And we can focus on where the clarity is right now. And that most definitely has not been in tech. It has been in communications. It's not been in consumer discretionary, but it is in Amazon. So you might say, Rog, what's that process? Index, sector, stock, right? It's the same top-down approach that we use day in and day out, day trading, swing trading, and even for our portfolio sessions in the mastery. That sector secret is know what's weighted. I think a lot of folks talk about top-down. I think it's a popular phrase, but they don't necessarily know why. So let me tell you why. When you understand the composition of the indices and the sectors are really based on a small number of stocks, you realize what a great advantage that offers traders. And once you know how to harness that, forget about it. It's like the magic decoder ring, right, to the markets. All right. So as always, gang, if you have any questions, feel free to type them in. Let's jump on into our questions. By the way, you can see what I've got queued up there on the left. That's the first session we'll be having this morning. Today in the Mastery, we have our day trading session, our swing trading session, and of course, our position portfolio session. And so we'll be covering a lot of aspects of what's going on in August today. All right. And there are opportunities in August, gang. The day trading has been pretty darn good. Not as good as July. The swing trading's actually been the same as July, if not slightly better, just a little bit less active. And there's a reason for that. July historical seasonal movement is very different than August. So we adjust to the month that we're trading. We adjust to the characteristics of that month. All right. First up, in terms of questions. Hey there, Penelope. What are the heaviest weighted sectors in the Dow? I know the NAS and S&P, but confused about the Dow. Yeah, Penelope, it's really interesting. We call it the Dow Industrial Average, right? I mean, this is the average that was created by Charles Dow many, many moons ago. And what's really interesting about it is that when you look at what we're dealing with the Dow, it's no longer the Dow Industrial Average. It might as well be the Dow Financial Average. There we go. It might as well be the Dow Financial Average. And what's really interesting about this is that industrials and transports are probably, gosh, you've got financials. If you want to write it down, financials, XLF, tech, XLK, and healthcare, XLV. You go down the line and you can get to the transports, the industrials, and even energy. But really, the Dow is very much glued to XLF and XLV. And by the way, it is also the outperformer amongst the Russell, the NASDAQ, and the S&P. And the reason for that is largely because of the difference in composition. I realize my toss is going to have to be restarted this morning because it is really cantankerous this morning. Okay. Anyways, sorry about the glitch. I can see it on my view when I'm going from symbol to symbol. All right. So let's see here. What's happening in financials? Francisco, there was some Moody downgrades. There's been a lot of, obviously, it's August, right? So let's just state the obvious. What happened to financials? What's happening to financials? August is happening to everything, pretty much everything but energy. So when we look at what's been happening with financials, we know there's some downgrades that have occurred. There are some different issues around just the choppy range in the indices and in the sectors. So I don't know if there's anything really specifically troubling in financials. It has more than maybe a news cycle, a morning, or maybe an entire session of concern or whatever. But I think this is mostly just August, Francisco. Yeah, in terms of what we're basically doing. Doing meaning chop, directionalist, mostly bullish, but definitely very much in the spin cycle of the washing machine. All right. After how many years, Vahid asks, after how many years trading did I achieve consistency and results? Vahid, I actually started with a very slow style because when I started trading in high school, actually, and basically flunking out of college because I was too busy trading in my dorm room to go to classes, things were slower, right? And I think there was a lot of benefit from not being too active early on. I actually did very well my first 2 years. A little bit of beginner's luck, perhaps, a favorable market environment at the time. But my third and fourth year got challenging. So I think a lot of traders struggle their first in the beginning part of their career. I'll call it lucky. In the beginning part of my career, I didn't struggle till around year 3, 4. And then in that struggle, because I had found some things that are working, I was able to really, probably by year 5, stabilize. And I've had, by the way, my entire career, I've never had a losing year. I've had very flat years, where I've just eked out a little bit of profit. But really the difference in consistency, to answer your question the best way I can, Vahid, consistency comes from risk management. And anyone in the sector secrets mastery knows this. The first thing that we quite literally bombard you all with, love and care with, is the Holy Grail. It's a spreadsheet. It's a set of notes. It's 2 videos that say, this is how to understand what to risk of your account on each trade and how to position size. And there's nothing more important than that. That's how you turn the corner, my friend. It's not a strategy. It's not a secret squiggle, which is what I call indicators, including some of my own, which I love, but it is risk management. Thank you for the question. By the way, if you want to know what we're doing in the Sector Secrets Mastery, come check it out, sectorsecrets.com. For those of you that have been asking, Rog, you're talking so much about shortening the time frame and day trading. Is that still something that works? Not only is it going to continue to work in August, of course, we're going to have tricky days, but not only is it going to continue to work in August, as long as there is concern, let me show you all something. As long as there is concern about what the Federal Reserve is going to do the remainder of the year. All right, let's go on over to the FedWatch tool. Here we go. As long as there's a lot of concern with this, gosh, that's bright. There we go. Going out into November, going out into December, right? Shortening the time frame is going to make sense because we as a trading and investing public are not certain that there is not another quarter point hike lurking in the shadows. And that's a lot of what we're seeing play out in the 10-year and in the 30-year, right? In terms of rates. All right. So that's definitely something I would keep in mind. All right. So next up is Ryan, who asks, good morning. Could I explain how I set my stop level for a long options trade? Example, do I base my stop off the underlying stock price? No, I don't. I base my stop based on a set percentage risk, depending on which scale in it is. We have usually 2 to 3, actually 1 to 3 different ways, levels, I should say, that we scale in. And so I set my stop based on premium paid. All right, next up, yields rise, stocks fall. Yep, I think we've got a little bit of, again, that lurking bond yield rising, a little bit more expectation in November or December. We're still firmly in a pause expectation. Well, I shouldn't say firmly. Firmly is usually what September looks like. No, I take that back. See how September's at 88.5? That's a pause. November gets tricky. Do you see how the November pause and hike columns, the pause column is to the left, the hike column is in the center. See how they're starting to get even? That's uncertainty, gang. And that's why sticking with short term, especially day trading, being flat at the end of the session, heck, sometimes being flat by lunchtime is going to continue to serve us. And it looks like for sure through the remainder of the year. With what's happening right now, with the emphasis on that shorter term time frame, that shorter term follow through, pencil this in, gang. I don't have the date yet, but we're going to have a special webinar and we're going to talk about some of these tactics that I'm using first thing in the morning to deal with the environment that we have going on. Because I would say early summer, we were seeing a little bit more expectation firmly of a pause. Okay, Fed's done hiking and now we can just go into pause till maybe March or May of next year when we cut. That's not what we're seeing, gang. So we're having to adjust to the macroeconomic reality. And the best way to do that is by not changing to some new indicator or even a different strategy, but it's how long am I exposing myself to risk? How long am I exposing my capital to risk? And remember, gang, day trading was the first type of trading when Wall Street was literally a big field with a wall next to it to keep the redcoats out. All right, so next up is good morning there, D. Bolton. Good morning. Good morning. All right, my essentials folks. Let's see here. Dane asks, I mentioned bombarding beginners with risk management. Absolutely. I'm just trying this room out. Where is there a good place to begin with my program? So this is a question from our essentials room. Dane, the place that I do all my trading 5 days a week, every morning, is in the Sector Secrets Mastery. Yeah, in the Sector Secrets Mastery. That's sectorsecrets.com. You can check it out. Or if you're in the Simpler Trading website, you can look at the different services, the different rooms that we have. It's a mastery. So what I would start off with, if you're looking to understand what I do, Dane, I mean, clearly be here in the essentials room when I'm here for Charts and Coffee. 3 days a week, ask some questions. And then when you're ready to dive in and immerse yourself in what I'm doing, check out what I'm doing over at Sector Secrets. Yes, absolutely. Okay. Next up is, let's see. You know what? Let's jump on over. I mentioned bonds a few times already. Let's jump on over to ZB. So when I take a look at the long bond, when I take a look at the 10-year, right, we're neutral this morning. We're trying to find where ZB and ZN are going to find some support. They're both in downtrends. So keep in mind that the path of least resistance with a red multi-trend on the daily is down. And we've seen that here for a bit. And bonds continue to reflect rising yields in the most basic sense. But why are yields rising? And there's a little bit of a game of chicken going on. I like to call it the liar, liar, pants on fire trade, where bond traders kind of tell the Federal Reserve, we don't believe you. We don't believe you're done hiking. We believe you're going to have to keep hiking. And we're going to front run your action with rising yields. And this is not an uncommon thing. It's a very common thing for the bond market to basically go head to head, play a game of chicken with the Federal Reserve saying, you've got it wrong, and we're going to price in to what degree you have it wrong. And then that's probably a good bit of why we continue to see rising yields, because bond markets are to some degree saying yields must go higher. And so that's the play there. Now, we don't have to play bonds. And I want everyone just to take a quick peek at something. There's always this notion that the S&P, the Dow, the NASDAQ cannot go higher with higher Fed funds rates or higher yields. That's simply not true. So again, just like we spent probably most of spring and early summer trying to finally kill the nonsensical sell in May and go away, we hopefully have killed that finally, because it's not true. It's not even properly stated. I hope to kill this notion that in a rising yield environment, the stocks can't rally. Of course they can, and they have, right? So please don't think just because yields are moving higher that that's it for the equity markets. That this is some harbinger to some cataclysmic drop. We have rallied as the Federal Reserve has continued to hike. They turned hawkish in October. We had our initial reaction in equities, and we've pretty much been, if you take a look at the year so far, we've been pushing generally in the Dow, in the NASDAQ, in the S&P to higher highs. It may not be pretty, but we're higher now than where we started off the year. So these are just some things that tend to get repeated that don't really have data behind them. Everything we do in the mastery is about, okay, here's an idea, here's a thesis, here's a narrative, where's the data? And I don't mean the headline. I mean data. So if you can put data behind your decisions, and at that point, what you're really doing, gang, is you're playing probabilities. You're saying, okay, I know that not everything is going to work every time around, but when Raghee puts an hourly price movement range, an HPMR up in a 5-minute chart, I know that it has nearly a 70% probability. That leaves 30% for the unknown, of course, right? These are not certainties. But if we can work probabilities and then we play our trades out to scale, we stick with the sequence, rinse and repeat, we're gonna put ourselves in the best opportunity to deal with even months like August. All right, gang. So that's a wrap. I will see you all tomorrow, same time, same station. And I appreciate that, D Bolton. I appreciate your I love having all the new eyes in the room. So many people learning and helping each other out. It's a great community. I do appreciate it. Thank you. All right, gang. If you want to check out what I'm doing, Sector Secrets Mastery, I'll see you tomorrow. Same time, same station. Be good to each other, gang.